Welcome to the KPC Smart Money Podcast with Kevin and Karen Chris. So today, lately, Karen, lately, Karen, we've been doing a lot of kind of lifestyle type things, right?
Yes.
And today we're going to do a financial topic.
Okay.
Because, after all, we are financial advisors.
Correct.
Right. So, we're going to talk about something that's, a lot of people might not even understand the title, the pros and cons of passive versus active investing.
Mm-hmm.
Right. Okay. So what does that mean to you?
So passive investing is where you put money into the stock market, whether that be a stock or an ETF, and you let it ride. Correct?
Yeah. So let's start from the beginning. Let's look at modern portfolio theory. Let's start with that.
Okay.
That would be, where passive investing, that's how it all started. And so the theory behind modern portfolio theory, which guy got, can't remember his name right now offhand, but he got a Nobel Peace Prize for in 1952. I'll think of his name after the podcast is over. But nevertheless, so the idea of modern portfolio theory, if you're invested properly and you're diversified, you shouldn't have to touch it. It's better off just leaving it alone, so.
Well, and how people will recognize this is a lot of times it goes off the rule of 100 based on your age. You take 100 minus your age. That's how much risk you should be in. So if you're 50 years old, your portfolio should be 50% equities and 50% stock. That's sort of the assumption of how the modern portfolio theory works. However, it's not working these days because bonds were considered your safe play in the stock market. But with these rising interest rates we've had recently, bonds have not performed well at all.
Do you remember just shortly, just a couple of years ago, 2022, do you remember what bond funds, the aggregate bond fund did for that year? Do you recall?
I do not.
Minus 12%.
Yeah, that hurts.
That's the safe part of your portfolio.
Yeah, and okay. So if you've got a part of your portfolio that's supposed to balance out stock market drawdowns or with the stock market going down, and it's going down at the same time, that is not good for your portfolio, just to put it in simple, basic terms. So the modern portfolio theory is just really, frankly, not all that modern anymore. A lot has changed since 1952.
Okay. Harry Moskowitz is his name. I just thought of it. But no, Markowitz. Markowitz. Anyway, the theory is if you're invested properly based on risk and you've got, think about a pie chart where you've got some large cap funds, which are big companies over 10 billion cap, meaning capitalization, right? Meaning they're over $10 billion in assets, right? That's a large cap. Mid cap would be 3 billion to 10 billion, and small cap would be, 2 million up to, yes, dear.
Well, no, I was just going to say, that's one of the cons, right? That's one of the cons to passive investing, but there's also some pros to passive investing.
Okay, so let's get back to the pie chart, okay? So the point is, sometimes, some years small caps will do rather well, and some years large caps will do rather well, and mid caps won't do well, but next year the mid caps may do well. So the idea is if you're properly invested and diversified, and you have some foreign stocks, right, and what they call emerging markets, which would be Asia and Africa, you got a small percentage of that. So think of a pie chart, right? You got pieces of the pie. Obviously, your emerging market piece will be a lot smaller than your large cap piece, right, which would be your IBMs and your Microsofts. Get it? Okay. So you're properly allocated, and the idea is if you're properly allocated, you've got some American U.S. bonds, you've got some foreign bonds, and so on. That's supposed to be the safe part. So the idea is you've got your pie chart, You might rebalance it a little bit, every 90 days or every year, whatever, but you're really not going to touch it that much. So the theory is in passive investing is that if you leave it alone, that over time it's all going to work out. And, and to a certain extent, that's true. You want to be diversified. There's also another saying that, portfolios are like a bar of soap.
Yes.
The more you touch it, the smaller they get, right? So you have to be careful if you get in there and you're trying to, outsmart the market and you're trying to figure, well, I think large caps are going to do better this year, so I'm going to, I'm going to get rid of the small caps. Got crushed last year, so I'm going to get rid of the small caps. I'm going to put more money in the large caps. And you're toying around with that, and you're trying to figure out and guess, right? That could be a disaster.
Right.
And that would be active management.
Right.
Okay.
So, the active investment, you've got yourself or an advisor who is pulling you in and out of stocks rapidly, or there's algorithms that are built right into these models that will automatically pull you in and out of the market. So a lot of people believe that that is a pro because someone is looking at that. They've put some sophistication into these algorithms. But to your point, Kevin, we really thought, about 10 years ago, we liked to have a portion of portfolios actively managed. But one of the cons that we discovered is these algorithms are really good at pulling you out of the market when certain trends are showing that whatever type of position you're in is going down. So these algorithms were great at selling off and pulling you out of the market, but they were really slow on the uptake. They were really bad at getting you back into the market. And a great example of that was the COVID V-shaped downturn and recovery. So these algorithms are going off. People are being pulled out of the market. Okay, great. You didn't take the full downside of the COVID V, but they were painfully slow on coming back. And so people missed one of the best upsides that had ever been in the market.
Okay, so trying to translate all that, market timing, we don't think market timing works, right? Trying to time the market and trying to make decisions that say, well, the wrong person is in the White House, so we should not be in the market. Well, there's been all sorts of studies that things like COVID and Ebola affect the market way more than who's in the White House. So if you're going to be in the market, check and see what is your appetite for risk and make your portfolio according to that. Now, let me just say, in closing this out, we would lean more to passive type investing with a little bit of tweaking. And what I mean by tweaking is we don't just decide to jump in and out of the market. We might replace one stock for another stock, but we're not going to get in and out. We're not going to try to time the market. We're not going to have algorithms that, tell us that we need to get rid of all the large cap stocks and get into all mid cap stocks. We want to have our pie chart, right, based on our risk appetite, but we want to do some tweaking. If we see that something's underperforming in a portfolio, if we have 20 positions in a portfolio, we might trade out one thing for another thing. So that's kind of in between active and passive, and we would call that dynamic, right? We would call that dynamic portfolio.
Well,
so
go ahead.
So anyway, we have to be careful that we're not just, going to, panic and just jump in and out of the market. And especially as advisors or people call up and say, well, the market's down 10%. What are you going to do about it?
Right. So all in all, to sum this up, we believe that you have got to have true diversification. You need the proper diversification in the stock market, but you need diversification outside of the stock market.
That's
too.
good,
We've
Karen.
got some creative ways to do bond alternatives outside of the market where you've got safety plays that are not stock based. That's one way you have true diversification. You want to have diversification with different asset class. You know, you don't want to have all your eggs in one stock market bucket. So we like to take a look not only at how to develop and create real solid stock market plans, but we want to look at other options also. Ultimately, you're saying, Kevin, we're not all passive, we're not all active, we're dynamic, and we're looking inside and outside the stock market.
That's right. So we're out of time for this podcast. We hope that helped a little bit. If you have more questions, you can go to kpcsmartmoney.com or kpcfinancialsolutions.com if you want to have a conversation. Until next week, be blessed.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should be construed as advice designed to meet the particular needs of an individual situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.